The silver price is lying and the spread is telling the truth, and so why the next 36 hours matter more than the last 36 weeks. There's a force in this market that hates disorder, that hates headlines, that hates a chart that looks like it's getting away from them. You saw it this week in the most predictable place on earth, the plumbing. Margin hikes, position pressure, liquidity pulled back right when everyone's eyes are glued to record highs. And the mainstream takeaway is going to be simple, lazy, and dangerous. It's a bubble, it's emotional, it'll pop. But that's not the part that matters. Because underneath that price candle is a different signal. One that doesn't tease, care about sentiment. One that shows up when paper promises collide with physical constraint. And if you understand that signal, you'll know what happens next week, what level matters, and what breaks first, if this turns from a violent rally into what people are already calling Silvergeddon. Here is the conflict in one sentence. Everyone else pointing at the chart and calling it mania, but the real fight is happening where leverage meets metal. When you see silver rip to fresh highs, when you see it print up into the 80s, and then snap back toward the low 70s in a heartbeat, that S not proof it, S over. That's the market showing you the two hands that are pulling in opposite directions. One hand is the crowd, the funds, the momentum, the industrial buyers who are suddenly paying up because silver is not a nice-to-have input anymore. It's a critical component in electrification, solar, electronics, data infrastructure, things that don't pause because the price chart got scary. And the other hand is the risk machine. Exchanges, clearinghouses, banks, prime brokers, entities whose job is not to be right about price, but to make sure nobody blows up so badly the whole chain snaps. And when volatility spikes, they don't argue with your thesis, they raise the cost of holding it. That's the suppression mechanism that isn't a conspiracy. It's incentives. They don't need to control price. They just need to make it expensive to stay long at the worst moment. And that's where the real pressure starts. Now layer in the headline that made your title inevitable, China's export restrictions. People keep calling it a ban because it sounds cleaner, scarier, and more clickable. But the hidden detail is sharper than a simple ban. The hidden detail is this. Supply didn't vanish. Access to supply got gated. And markets don't panic when something is scarce. Markets panic when something becomes conditional. When supply moves from, you can buy it if you pay the price, to you can buy it if you qualify, if you're approved, if the paperwork clears, if the timeline matches, the entire pricing model changes. Because price discovery assumes frictionless flow. The moment flow becomes political, administrative, or strategic, you don't just get higher prices. You get higher volatility. You get regional dislocations. You get spreads that start screaming. You get inventory anxiety. And you get this weird phenomenon where the paper price can look calm for a few sessions, while the physical market tightens like a fist. That's not a theory. That's a pattern. And the next detail is what flips the whole setup. Because 36 hours to Silvergeddon isn't about a clock on your wall. It's about the calendar inside the market. This is the most underappreciated catalyst in commodities: timing, delivery windows, notice periods, thin holiday liquidity, funds rebalancing at month end, quarter end, year end, risk limits resetting. And right now, you've got a brutal overlap. New export rules taking effect right as liquidity is thinner and risk managers are less tolerant. You just watched a version of this play out when margins were raised after extreme moves. That's what happens when the calendar turns into the catalyst. And if you're wondering why the next 36 hours matter, it's because weakened gaps and thin liquidity turn normal buying into disorderly buying. They turn I'll wait for a pullback into to get filled where I want. And that's how squeezes go vertical. Not because everyone suddenly became emotional, but because the market's ability to absorb orders collapses. Now let ES address the phrase that AS going to trigger skeptics. Jointly psychics delivery spike. If you're new to the silver plumbing, this is where people get lost and start either fantasizing or dismissing everything. So let's be clean. A futures market is built on the assumption that most contracts will never touch metal. Most contracts are rolled, closed, offset. That's not evil. It's how hedging and speculation coexist. But when you get a delivery surge, when you get a sudden wave of participants choosing to stand for delivery instead of cashing out, that it's not just more speculation. That's a decision to convert paper exposure into a claim on physical. And when that decision spikes, it stresses the system in a very specific way. It forces metal to move or forces someone to pay up to avoid moving it. Either way, it tightens the front end. And that's why the spread tells the truth. You want a concrete picture? Look at what big delivery actually means in silver. One standard COMEX silver futures contract represents 5,000 ounces, not 5 ounces, 5,000. So when a day prints thousands of contracts issued for delivery, you're talking about tens of millions of ounces being put into motion on paper. metal that must be delivered, sourced, or otherwise managed through inventories and warrants. And this is where people make a fatal mistake. They look at total warehouse inventory and assume it S, all available. But that's not the part that matters. The next detail is what flips the whole setup, and it's the trapdoor of inventory categories. In the COMEX ecosystem, not all warehouse silver is deliverable at the flip of a switch. Warehouses report categories that matter because the market is a legal framework, not a pile of shiny bars. One bucket is effectively registered, metal that is warranted and available to meet delivery obligations. Another bucket is eligible, metal sitting in approved vaults that meet specifications but is not currently registered for delivery. Eligible is not fake, it's real metal, but it's not committed. It's not pledged to satisfy delivery. It can be owned by parties who have zero interest in delivering it at current terms. It can sit there and look like comfort while the deliverable float, the metal that can actually be handed over without negotiation, is far smaller. And when delivery demand surges, the market stops caring about total ounces and starts caring about the deliverable float. That's why, during stress, you'll see a psychological phase shift. The same inventory headline that looked ample last month suddenly looks tight, not because ounces evaporated, but because the market realized the difference between exists and available. And that's what paper traders miss. They think price is the whole story. In real commodity stress, the curve becomes the story. The spread becomes the story. The cost to get metal now versus later becomes the story. When the front end tightens, when nearby contracts act stronger relative to deferred months, that's the market putting a premium on immediacy. That can show up as backwardation or as a flattening curve that refuses to pay you to wait. It can show up in exchange for physical dynamics and the subtle signals that tell you the system is being pulled. And here's why that matters this week. Spreads can move before spot does. Spreads can scream while the headline price looks fine. And when the headline price finally reacts, it tends to react fast. Because if this one level breaks, the math changes. Now bring China back into the frame, but correctly. The scary version of the story is China bans silver exports, world runs out. That's too simple. The more realistic, more powerful version is China inserts oversight and licensing into exports at scale. That changes who can ship, how fast they can ship, and how predictable global supply is for buyers who can't afford surprises. Think like an industrial procurement manager. You don't care about a tweet. You care about lead times. You care about contracts. You care about whether you can source on schedule without paying panic premiums. The moment export flow becomes gated by licensing, by qualification, by scale thresholds, it doesn't need to eliminate exports to shock the market. It just needs to reduce flexibility. It needs to make the marginal shipment harder. It needs to force smaller exporters out and concentrate supply into fewer hands with state oversight and strategic priorities. That's not a silver disappears story. That's the marginal buyer must pay more, sooner, and with less certainty story. And that's where the real pressure starts. Because silver isn't a faucet. Even if price doubles, silver supply can't surge on command. A huge portion of mined silver is a byproduct of other metals. Lead, zinc, copper. That means silver supply is constrained by the economics of other markets. Miners don't just turn up silver production because silver is hot. They respond to the primary metal economics, and silver comes along for the ride. Then you hit refining and logistics. You hit assay, fabrication, transport, insurance, financing. You hit real lead times. Recycling helps, but recycling doesn't scale instantly either, and it tends to respond with lag. So when demand accelerates, industrial plus investment at the same time, the market doesn't smoothly equilibrate. It jolts, it gaps. It throws volatility at anyone who's overlevered. And that volatility is not random. It's a weapon the market uses to shake out weak hands. And you need a psychology shield for that, because the tape will try to make you irrational. Let's stack proof the way a serious metals crowd demands it. First proof point, the price action itself. Silver pushed to fresh records and then snapped back hard after margin requirements were raised. Classic behavior in a leveraged market where the exchange is effectively telling you, pay more to keep playing. That doesn't disprove tightness. It proves sensitivity. It proves that leveraged positioning has become large enough that when the cost of carry spikes, liquidation appears instantly. And that's why you can get violent drops even when the bigger thesis is intact. Second proof point, the policy timing. Export restrictions that begin right at the turn of the year are not random. They hit when contracts roll, when liquidity thins, when risk budgets reset. That's a calendar catalyst. Third proof point, delivery behavior. When the delivery pipeline runs unusually hot, when issuance totals are in the thousands of contracts for a single delivery month, we're talking about tens of millions of ounces being called for. That's not a vibe. That's mechanics. Fourth proof point, the supply chain narrative from industry itself. The market isn't just investors buying coins, it's manufacturers warning about input cost shock. It's solar and electronics facing a metal that is suddenly behaving like a strategic commodity. Fifth proof point, the curve and spread behavior that tends to accompany real tightness when now metal commands a premium over later exposure and the market begins to pay for immediacy. And here's the sixth layer that people ignore, global price dislocation. Because silver is global, but it doesn't trade like a single pool when friction rises, when regional prices diverge, when one region pays a premium and another looks normal, arbitrage is supposed to close it. Traders buy in the cheap region, ship to the expensive region, pocket the difference. That's the magnet. But arbitrage only works if metal can move, if finance is available, if logistics are smooth, if export licenses don't choke flow, if refining form factors match what the buyer needs, and if time risk doesn't kill the trade. The moment those conditions break, the magnet weakens. The gap can persist, and when gaps persist, it tells you something. Scarcity isn't about total global ounces, it's about the ability to deliver the right form in the right place, on the right timeline, under the right rules. That's the hidden detail in practical form. And the next detail is where this turns from interesting into dangerous. Because when physical tightness rises, it collides with a paper market that was built for netting, not mass conversion. Again, not a conspiracy, structure. A futures market is a promise with optionality. If you're a speculator, you can buy and sell that promise without ever touching metal. If you're a producer or industrial consumer, you can hedge price exposure without storing a mountain of bars. That's the utility. But the whole system relies on most participants not demanding delivery at the same time. When the percentage shifts, even if the absolute ounces are still manageable, the psychology changes. Participants begin to treat the paper contract like it might not behave like cash. They begin to prefer the hard asset over the claim. They begin to think in terms of access risk. And access risk is contagious. It spreads faster than price. Now let EOS talk about the force that tries to suppress without ever needing to manipulate. The market has built-in stabilizers. Margin is one, position limits are another, volatility controls are another. When silver gets too hot, the exchange can raise margins. That forces leverage traders to post more collateral. Some can, some can't. The ones who can't must reduce positions. That creates selling pressure, it knocks the price down. Headlines declare victory. Bubble popped. And then, quietly, the physical market keeps bidding. That's the setup for whipsaw. Because the selling wasn't a fundamental shift, it was a financing event. And financing events are temporary, but they can be vicious. And this is where retail investors get emotionally manipulated. Here's the viewer psychology shield you need. And you need it before the next candle prints. The market will use three emotions against you: euphoria, fear, and shame. Euphoria makes you chase vertical moves at the worst entry, with the most leverage, into the thinnest liquidity. Fear makes you puke positions after margin-driven dumps, right when forced sellers have already done the selling for you. Shame makes you freeze, so even when the market offers a clean setup later, you don't take it because you're still haunted by the whip. The antidote is simple but not easy: separate trend signal from noise. Trend signal is what the curve, inventories, and policy regime are doing. Noise is what a thin liquidity liquidation candle does when collateral requirements change. You don't have to predict every tick. You have to know what would confirm the thesis and what would invalidate it. Because if you don't define invalidation, the market will define it for you at the worst possible moment. And that's not the part that matters. So what actually matters in the next week or two? A checklist, not vibes. A checklist. First, watch whether the front end stays tight. If nearby contracts remain stubborn relative to deferred months, if the curve refuses to pay you to wait, that is a pressure signal. If the curve relaxes and contango expands, if the market starts offering you carry again, that is a cooling signal. Second, watch delivery and warehouse behavior in the way professionals do. Not total inventory, but what happens to deliverable float and how fast it changes. If deliverable supply shrinks while delivery demand stays elevated, tension rises. If deliverable supply expands smoothly and premiums ease, tension cools. Third, watch the policy reality, not the meme. Export controls that are enforced tightly and unpredictably are different from rules that are announced loudly and implemented softly. The market will sniff that out through availability and premiums. Fourth, watch volatility and margin policy, because it tells you when the exchange is prioritizing stability over participation. When margin goes up, leverage comes out. That can create short-term dumps that feel like doom. Sometimes they're just plumbing. Fifth, watch the cross-market behavior. Do silver miners behave like a metal with staying power or like a blow-off? Do related industrial metals show stress or substitution? Do safe haven flows into precious metals remain broad, or does silver decouple? And the next detail is what flips the whole setup if it happens. If a violent dump fails to break structure and is followed by immediate, relentless buying, that's reflexivity. That's a market. telling you the dip was used to reaccumulate. That's where squeezes are born. Now I want to be explicit about the counterpoints, because trust is built when you show your work and your uncertainty. There are clean ways this story deflates. 1. Demand destruction. If the price of silver stays elevated long enough, some industrial users can thrift, substitute, redesign, delay. Not all can, but some can. 2. Policy nuance. If the export restrictions are more about paperwork and less about volume, the market may have overreacted to the word ban. 3. Inventory response. Eligible stocks can become registered if owners are incentivized, if spreads and premiums make it worth it. That can relieve immediate tightness. 4. Speculative exhaustion. If too much of the rally is leveraged momentum rather than real procurement, margin hikes can trigger a cascade that takes longer to repair. 5. Macro regime shifts. If real yields jump or the dollar strengthens hard pressed, precious metals can get hit even with strong fundamentals, because flows matter in the short run. So you don't get to be religious about silver. You get to be conditional. You get to be mechanical. Because if this one level breaks, the math changes. And that brings us to the 36 hours promise. What happens next in a way you can actually use? Over the next 36 hours, you're likely to see one of two things. Either the market tries to cool this off with a controlled pullback, liquidity returns, spreads relax, the tape stops feeling like it's being chased. Or the market turns the weekend and thin liquidity into a catalyst, front-end tightness holds, physical anxiety doesn't fade, and any dip gets bought faster than it can form. Those are not predictions. Those are scenarios. And scenarios keep you sane. Scenario 1, controlled pullback and retest. In this scenario, the market respects the reality that it ran too far too fast. The pullback is sharp, but not structural. You see volatility, you see scary candles, you see the usual "it's over" chorus. But the key is what happens after. Price stabilizes, finds a level where buyers defend, and you begin to see confirmation in the plumbing. Spreads stop deteriorating. Warehouse behavior stops looking like a scramble. Premiums don't explode further. This is the healthiest bullish outcome because it rebuilds the base without breaking trust in price discovery. It also lures shorts back in. And that's where the real pressure starts, because shorts that re-enter too early can become fuel for the next leg. Scenario 2, continuation squeeze and gap risk. In this scenario, the market refuses to give you a clean pullback. Liquidity thins, and every attempt to sell gets absorbed. The front end stays tight. The spread tells the truth louder. Regional premiums stay elevated. Delivery chatter stays hot. And then you get the thing that wrecks both bears and undisciplined bulls, a gap. A price jump that happens when you can't trade it, when stops don't save you, when the market reopens at a different level because the bouncing happened off screen. This scenario is where people make permanent mistakes. Bears get run over. Bulls over-leverage because they feel invincible. Then a margin shock hits again and price whips down violently, even though the squeeze conditions remain. That's how the market uses volatility as a weapon. And if you don't have a plan, you become the plan. So what confirms which scenario you're in? Confirmation is never one candle. It's the stack. If you see price pull back but the curve remains tight, that's bullish under the hood. If you see price pull back and the curve relaxes sharply, if the market starts paying you to wait, that's a cooling signal. If you see delivery and inventory behavior stabilizing, that suggests stress is being managed. If you see delivery intensity remain elevated and deliverable, float tighten. That suggests stress is compounding. If you see repeated margin hikes, that suggests volatility is high enough that the exchange is prioritizing system stability, which can create forced liquidation events. Those events can be opportunities or traps, depending on your time horizon. And that's the part that matters, time horizon. Most people lose in commodities, not because they're wrong about direction, but because they're wrong about timing and leverage. They're right that the world wants more silver for electrification and data infrastructure. They're right that policy and geopolitics can turn supply chains into strategic weapons. They're right that paper can decouple from physical when access becomes conditional. But they're wrong about the path. They expect a straight line. They expect fairness. The market delivers whiplash. It delivers margin shocks. It delivers weekend gaps. It delivers fake-outs that exist solely to test whether you have a plan. And if you don't, you'll sell the low, buy the high, and then swear the market is rigged, when the truth is simpler. The market is designed to punish weak structure. So here's your near-term roadmap. Simple, practical, and brutal. 1. Respect that price can whip around violently even if the thesis is correct. Don't confuse a forced liquidation candle with a fundamental reversal. 2. Separate signal from noise. Signal is the curve, delivery behavior, and policy regime. Noise is the headline, hysteria, and thin liquidity spikes. 3. Watch the calendar. Delivery windows and rebalancing periods don't care about your feelings. They change flows. 4. Watch for the moment the narrative flips. Right now, the narrative is bubble. The flip happens when industrial voices and procurement behavior dominate the conversation, when people stop talking about speculators and start talking about availability. 5. Define invalidation for yourself. If tightness signals fade, if spreads relax and premiums collapse while inventories rebuild, then the panic thesis weakens. If tightness signals persist and policy gating remains real, the bigger thesis remains alive even through violent pullbacks. That's your anchor. And let's talk about the final trap, the need to be a hero. You don't need to call the exact top or bottom. You need to survive the volatility and be positioned for the regime. If silver is transitioning from a trade into a strategic input, you won't get paid in a straight line. You'll get paid by being right about the structural direction and disciplined about the path. The market will offer you moments where everyone screams, "It's over." It will also offer you moments where everyone screams, "It's going to the moon." Both screams are manipulation, even when they're sincere. The only thing that matters is what participants are forced to do. Are shorts forced to cover? Are funds forced to de-risk? Are industrial buyers forced to pay up? Are warehouses forced to reclassify inventory? Are exporters forced to comply with gating? That's the real market. The rest is theater. Now here's the concrete payoff I promised at the start. What breaks if this escalates, and what to watch next week? If this escalates, the first thing that breaks is confidence in paper is as good as metal out for marginal buyers. Not everyone, not always, but enough. And when enough participants prefer the hard form, prefer delivery, prefer allocated, prefer certainty, you get a premium for certainty. That premium shows up in spreads and availability before it shows up in headlines. The second thing that breaks is the ability of leverage to stay cheap. Margin hikes and volatility controls become more frequent because the system must protect itself. The third thing that breaks is narrative control. The market stops listening to people calling it a bubble and starts listening to the people who can build products without silver. And when that happens, dips become shallower, rallies become faster, and the weekend becomes dangerous. So in the next week or two, if you want to be early rather than late, don't stare at the spot chart like it's the only truth. Watch whether now stays bid. Watch whether stress signals persist through pullbacks. Watch how quickly the market rebounds after forced selling. Watch the calendar. Watch the policy follow through. And watch your own psychology, because that is the one part of this system you can actually control. If you made it this far, you're not here for dopamine. You're here for mechanics and signal. Stay in that identity. Share what you're seeing in the spreads, in the delivery chatter, in the physical premiums where you are, because the fastest way to beat the narrative machine is to build a community of observers who look at the plumbing, not the headlines. And if the next 36 hours do what stress regimes often do, if liquidity thins and the market tries to shake you, remember this: the silver price can lie for a while, but the spread can't fake urgency forever.